anytime you start anything in life, you should have the exit plan already in mind, right? I mean, you will be so much more successful if you do that in pretty much everything in life. You need to know what the outcome is, and you need to know your exit strategy when you start. Thanks for joining us for today's episode of The Capitalist Investor. I'm Mark Tepper, along with Derek Gabrielson. D, what's up, bud?
What's going on, Mark? How are you today?
Good. I told you I'm hungry. I got to eat soon. But overall, man, we have to be pretty good because when you look at the stock market is right back at or near all-time highs once again.
Yep.
Pretty quickly.
Very quickly.
Right?
Yep.
So I think that's what we need to talk about on today's episode is really, where does the market go from here? Right? It's pretty crazy. If you go back to the Great Recession, the market hit a peak of somewhere around like 1565, and obviously I'm referring to the S&P 500. Hit a peak in October of 2007 of around 1565.
Right.
It took us almost 6 years to get back to that level. 6 years, right? It's taken us 6 months to do it this time.
It's crazy. It really is.
It's unbelievable.
It's hard to even calculate in your mind.
Yeah. I mean, it has me feeling skeptical.
For sure.
Without a doubt. I mean, I'm not one of those raging bulls who says, like, hey, everything's great. Has us a bit cautious right now.
Yep.
Right? I don't know that at all-time highs, given everything we know about the economy as it stands today, I don't know that I'd be plunging money into index funds right now.
No.
Like just blindly buying the S&P.
Right.
I mean,
especially now with everything that's changed so drastically in the last 6 months, it's hard, just to start piling money back into the index funds. We can go back to our favorite saying, the rising tides lift all ships.
Yes, or boats or something. Yeah, something along those lines. This is a good one.
So, it's especially in the very short term, is definitely going to be picking the right stocks in the right sectors.
Yes, without a doubt. So, and I think that's a great point. There are clear winners in this recovery, and there's clear losers.
Right.
I mean, obviously, hospitality, travel. You look at the hotels, the airlines. I just took my son out to SoCal a couple weeks ago, and we flew United. The flights were maybe at 50-60% capacity, plus they're cutting flights too.
Oh, yeah.
Right? I mean, they've probably cut, I don't know, I'm going to ballpark it and say 25 to 40% of flights.
Oh, yeah.
And then the flights that are remaining aren't even full.
Right.
So, I mean, there's obviously going to be winners. There's going to be losers. But when we look at the stock market, as you're looking at the stock market in general, I think you need to begin to favor active management strategies over passive for the reasons we just talked about.
Yep, for sure.
Right?
For sure.
Making sure that you're in the winners and you're minimizing your exposure to the losers. Now, look, we're always going to own losers. even when we're trying to pick all winners, nobody gets it right all the time.
Yeah, no one's batting 1,000.
No one's batting 1,000. So we pick losers too, right? But I think the key is when you have a loser, you can't be emotionally attached to it.
Right.
You got to cut your losses.
For sure.
You got to sell it and you got to move on. And what I've found, D, is that obviously we have a very robust risk management and investment management process in place for our clients. But what I've found when I've traded my own personal accounts is that anytime you start anything in life, you should have the exit plan already in mind, right? I mean, you will be so much more successful if you do that in pretty much everything in life.
Right.
You need to know what the outcome is, and you need to know your exit strategy when you start. Whether that's starting a business, you should know, hey, I want to grow this thing from $0 of revenue out of my mom's basement to $100 million of revenue, and I want to sell it in 7 years, right? It'd be phenomenal if you did that. But begin with the end in mind, right? Let's assume you buy Apple, and Apple's, it's through the roof, but we'll say it's $400 a share. I know it's above that. $400 a share. You buy it. You put $10,000 into Apple. You probably want to set some parameters on your portfolio. Hey, when it gets to $500, I'm going to take a third off the table. Right? I'm going to start to cash out. If it goes the opposite way on me, if I buy at $400 and it goes down to $300, I'm taking a third off the table as well. I'm managing my risk. Or maybe you set parameters that no matter where the stock is at, no matter how much you're in love with the stock, if it moves the wrong way 10%, you're out. You close out your entire position, right? So, I think right now looking at individual stocks really is the way to go, but you have to do it in the best way possible, which is making sure you begin with the end in mind. Go ahead.
I'm sorry, yeah. And we've talked about this before on this show, the kind of the behavioral finance issues that come into play. And when markets are volatile like this and quite frankly a little bit unpredictable, when you have this COVID stuff out there and you just don't know which way it's going to break every single day, it really becomes even more important to have things like that in place. Because you did that great analogy comparing it to starting a business, but it's really with all things in life. You really just need to have some sort of plan going into them. So it's really beneficial, especially now, especially with a lot of new investors out there as well. Why are you buying into this particular stock, and what are your expectations for it? But more importantly, when you're gonna cut your losses and back out. I think just in my experience and talking with so many people and families over the years, that's really where people lose potential and lose obviously money by, even if they set those low end parameters, they get emotionally attached to the investment and kind of blow through those. So, like for Apple, if your bottom is 350 or whatever it is, you can rationalize keeping the stock if it goes below 350, right? It doesn't have to be Apple. It could be anything out there. So, stick to that game plan. It's really important because your emotions will get tested at the bottom. Right? You obviously bought that stock for a reason. You like it. And it's hard to admit defeat sometimes.
Right. No doubt. So let me share with all of our listeners something that they may not know, but it's something that we're doing in the background. Right. So every time, I shouldn't say every time, nearly every time I'm on TV, the producers for those various shows or segments, they're interested in anything that we are buying and selling. Okay. So, over the course of the last 6 to 9 months, we've been selling Apple. Just trimming our position. We're taking profits, man. Right? Whenever a position starts to overtake a portfolio, right? If we have a target position on Apple at 3% of our portfolio, and it's done so well that it's at 4.5%, we got to trim. Right. And eventually you get to this point where you're playing with the house's money. Right? Which is, that's the best way to do it.
It's a good spot to be in.
If you can do that well in Vegas, you're doing all right. So I'll often say, hey, look, we're long Apple, but we're selling. Right. We are taking profits. We want to make sure that those aren't just paper gains, that they are real gains, right? And no gain is real until you sell it and put some cash in your pocket. And maybe I shouldn't say in your pocket, but you have some cash in your portfolio. Right. So, Dee, I want to share with you some different returns on the stock market because we're trying to figure out where's the market going to go from here. Right. And I think it's pretty fully valued right now. I would expect it to kind of trade sideways. But, I just saw on CNBC today a guy by the name of Ed Yardeni ratcheted up his end of year estimate. He went from 2,900 to 3,500. So I'm assuming a bunch of people are going to start doing that now. Right. Everyone's going to ratchet up their year-end targets on the market. So I want to share some things with you because obviously this is an election year. All right. So we're getting questions from clients right now with regards to what happens if Trump stays in office, what happens if Biden wins, like what's better for the market. And I've heard time and time and time again, and you can go back through history and you can say, well, when Democrats are presidents and here's the performance, when Republicans are presidents, here's the performance. But I really don't pay too much attention to that. It's really, if you take office at the right time, when the market's at the bottom,
right,
your performance is going to look great.
Much better.
So let's look at Obama's presidency. Okay. So the guy was elected November of 2008. Trump was elected November of 16. All right, so we're going to use the time period between November of 08 and November of 16.
Okay.
Reason being, when Trump was elected in 16, we all remember this because it was only 4 years ago, the market accelerated quickly while Obama was still in office, but because the market knew that Trump was taking office in January, the market accelerated. So I think the right way to look at this is from election day to election day.
Totally agree.
All right. So November of 08 to November of 16, the total return on the S&P 500, 159%, an annualized rate of return of 12.6%. That sounds pretty darn good.
That's pretty nice. Yeah.
Pretty darn good. Okay. Now, let's put that in context here. Okay. The market peaked prior to the Great Recession in October of 2007, somewhere around 1565. It took until, I believe, April of 2013, that's just shy of 6 years, for the S&P to get back to that 1560-ish level.
Right.
Over the course of that time frame, the total return on the S&P, now total return, I should specify, includes dividends. So if you're an investor, you're not just looking at price appreciation, you're pocketing your 2% per year dividend as well, right? And when the stock market's lower, the dividend yield might be a little bit higher. Total return over the course of that 6-year period, a whole whopping 12.9%. Annualized 2.25%. Now, we've done a show on this in the past, D, where we were debating what's a bull market and what's a bear market. When can we say that we're in a bull market, right? So the market was at almost 3,400 back in February. It dipped down to around, I think, like 2,300 at the March lows, and it's right back up to almost 3,400.
Right.
Maybe by the time this is running, it will be past 3,400. I think we both agree that the bull market doesn't start until you exceed the prior peak, right? So if we have surpassed the February peak, I would consider today or sometime over the next week the beginning of the bull market.
Right.
Right? So when you go back to October of 2007, and a lot of people they'll claim that during the Obama presidency, they'll claim the 12% annualized return.
Right.
They'll say that we were, the economy was great. Well, yeah, dude, you started at the bottom. Yeah, of course, everything gets better at the bottom.
Same points are made with the unemployment rates over those times as well.
Correct. And then they'll say that Obama was responsible for what ended up being a 10-year long bull market, but he was responsible for at least 8 of those years. Now, I'm going to counter that, and I'm going to say that's just not even remotely close to being accurate, because if I go back to October of 2007, which was the peak, through the end of the quote-unquote Obama presidency, which would be when Trump was elected in November of 2016, the annualized return goes down to 5.7%.
Yep.
So I think when you look at, and I'm just trying to put this stuff in perspective, right? I don't want someone to think, oh, well, if there's a Democrat president, there's going to be 12% annualized return. It doesn't work like that, right? I mean, it's all, look, the number one determinant of performance is where you get in and where you get out.
Right.
In fact, that's 100% of performance.
It is, yeah.
So, people are able to select certain time frames and manipulate the numbers to their benefit.
If you spend enough time on it, you can manipulate the numbers to really do what you want them to do.
I was talking with a prospective client a couple weeks ago, and we were showing him some forward-looking expectations on portfolio performance. And D, as you know, we're very conservative with our projections.
Right.
If we can average 10% per year for our clients, that's freaking awesome. Okay?
Yep.
I'm never going to show that. I would show 6%. I mean, some 5%, something realistic. And if their plan works at 5 or 6%, then it's really going to zing if we're able to do 10.
Right.
But he was concerned that the return expectations we were showing were too low, because according to him, the historical return on the S&P is 10%. Now, I don't know where he got that from. I don't know what time frame he used. Did you start after the Great Depression? Did you start before the Great Depression? Like, when did you start? So there's certainly a huge differential in the ranges of returns depending on where you start and obviously where you go to. But I thought it was pretty significant, D, that what is advertised as the total return on the S&P during the Obama presidency is 159%, okay? When in actuality, the total return was only 66%.
Right.
So we only ended up 66% above that prior peak of 1565. Not bad. Still not bad. I mean, 5.7% per year is not terrible. Those are not bad returns. It's a lot of risk to be taking for a 5.7% return, If I'm 100% invested in equities and I only averaged 5.7% over the course of that time, I got to say, I lost a lot of sleep.
Right.
And I really didn't make a ton of money, okay? But future expected returns are certainly going to be lower than historical returns. So from my perspective, the real total return during the Obama administration's positive 66%. In the Trump administration, half as long. We're not even 4 years in. Total return through middle of August 2020, 70%. So it's 4% greater than what Obama realized for an annualized return of 15.11%.
Nice.
That's not too shabby, man. So look, there's a lot of Trump haters out there. And I'll admit, the guy's an idiot. He's a jerk, dude. He's a narcissist, right? I mean,
you did say the coronavirus was just going to magically go away by itself like a week ago.
Nobody ever said he was the nicest guy ever, that he had the best bedside manner, okay? Nobody has ever said that about President Trump.
Yep.
What I will say is his policies have been unbelievably effective. Unbelievably effective. We've been at war with China for years and years and years, and we didn't know it. We didn't know it. We were just getting our butts kicked, all over the place, man. They're stealing our intellectual property. They're spying on our kids right now on TikTok. And President Trump was the first one to say, I'm willing to take a little short-term pain to make sure China does not take over as the number one world power.
Right.
Right.
Which is clearly their goal.
That's clear. They've made it public. They've got this, I don't know if it's a 10, 20, 100-year plan, whatever the heck they do. Communists do weird stuff. But it is definitely part of their plan.
Right.
And they specifically said that if they were to go to war with us, and this was probably a couple years ago, it would be a quote-unquote new kind of war, which is the Cold War that we're fighting with them right now. So, President Trump dug his heels in and said, you're not going to bully us anymore. Now, normally, if you're in school, everyone that's listening was probably in school at some point, right? If you're at school and there's someone bullying another kid, and there's a guy or a gal who steps in to help that other kid, that person's a hero.
Right.
The person that ends the bullying is a hero.
Right.
Right? So President Trump has done that, and it's been very effective. And, beyond that, he has generated a pro-growth economy by lowering taxes. I mean, our corporate tax rates were anti-competitive at 35%. and he got him down to 21, so that we're at least competitive again. Right. Simplified the personal tax code a little bit. Now, I'm not saying that everyone benefits from it. I don't think it helps me at all. Probably doesn't help you. I mean, for those of us with children, for those of us who are accumulators who probably don't have a paid-off house yet, we used to like those itemized deductions. We used to like the personal exemptions associated with our, us, our spouse, our children. Those are all gone, right? So more and more people are taking the standard, or they've been modified. The exemptions are gone. Itemized deductions have been modified. But look, his policies have been effective, and the market's up 15% annualized since he won the election.
Right.
Okay. Where do we go from here, man? Because look, the market is typically priced on a multiple of the next 12 months' earnings.
Right.
Okay. So if I go out to 2021, the street, Wall Street, has us at $164 in earnings on the S&P 500. Let's put that in context. In 2019, we were at 163. So we would actually be at a record high earnings number if the street is correct. Now, the street's never right. So these will come down.
And they're definitely making stuff up right now.
Oh, my God. That's why earnings season was such a blowout. Because
and you have to, I mean,
there was no guidance.
There's nothing to go on.
There was no guidance, so they set the bar low, and everyone just completely crushed it. So yeah, where does the market go from here? I mean, $164 next year? I don't think that's going to happen. When we talk with our investment team here, they're telling us 140 to 150. 150 stretching it, because I just don't know that the economy is going to be full go in 2021. And by full go, I mean running at the speed it was running at in 2019.
Right.
I think there's going to be, now I think by 2022 we'll be full go, right? I think it's going to take a little more time to ramp up. I don't expect the economy to do what the stock market just did.
Right.
I don't. I expect the economy is going to just take a little longer to grow back. Now, let's use the high end of our range at 150. If we apply, so $150 for next year, if we were to apply a very generous forward multiple of 20 times earnings onto that $150, that puts us at a 3,000 year-end target.
Yep.
Right? Now, look, I can argue and say, well, multiples should be higher, right? I could say multiples should be higher because the 10-year Treasury is bouncing between 50 and 70 basis points on a day-to-day basis, right? So interest rates are low. And for any of you who have ever done any homework on time value of money, you know that the lower the discount rate of future cash flows, the higher the immediate valuation or the present value, right?
That was good. That was a nice explanation.
Yeah, thank you. So, I forgot what I'm talking about here.
So I threw you off with my compliment there.
Where
so we were talking about 19, or so with about 150
all right, so
to get to about 3,000.
Backing up to that. So, all right, so we were talking future cash flows, discounting back to present value. So, I mean, that would put us at 3,000. I could argue that maybe the multiple should be 22. I could get aggressive and go to 25. There's not much I can do to get to a 3,400 year-end target, which is pretty much where we're at right now. Not much I can do there. So, I mean, it's interesting. I guess my take is I think we've pulled some future returns into these last 6 months. Right?
That's a great explanation.
So are we going to get double-digit returns for the next couple of years? I don't think so. I hope I'm wrong. The fact that we got back to even it's commendable. It's remarkable. So we'll see.
Yep. So, it's really we'll be doing several shows, I'm sure, leading up to the election and kind of what we can expect from multiple outcomes. I know we're working on the same thing for our clients. Been talking with lots of clients this week about those subjects. But it's sometimes it's as simple as what you said at the beginning of the show. It's where you start is the most important part.
Yeah,
yeah,
exactly.
So if we're kicking off 2021 at a very, very high level, very high evaluation, it's going to be really difficult to produce those returns that we've seen in the last few years.
Yeah, I agree. So I think people just need to put that in perspective.
Yep.
Right. As you're building out your portfolio, again, be specific. Now, look, if you're a DIY investor, I don't know that I can tell you that you should be buying individual stocks. It's tough. I mean, we spend a lot of money on research, technology, human capital to try and give us an edge when
Right.
it comes to picking individual stocks. I couldn't imagine sitting at home in my pajamas all day, day trading, trying to pick stocks without having a very, very large budget that I could use to buy research and stuff like
Right,
that.
for sure.
So if you're an at-home investor and in most of your portfolios, ETFs and mutual funds and stuff like that, I certainly wouldn't expect a 15% annualized return. I don't know, maybe 7. So maybe half of what we've gotten, because I do believe that we've pulled forward some of those returns. Now, last thing I want to wrap up with is, what are the catalysts that could take the market even higher? And so that we have another podcast episode where we talk about how ridiculous it's valued at that point in time, right?
Mm-hmm.
What are the catalysts? And the number one I have come up with, and this is something that President Trump is kicking around right now, is lowering the capital gains tax.
Mm-hmm.
And he's looking to do that through 2 different ways. The first way is actually lowering the tax rate. Looks like they could reduce the effective capital gains tax rate by 8 to 25%.
Mm-hmm.
Okay, so if it's 20% and you reduce it by 25, it goes down to 15%, right? Beyond that, they're looking to index inflation as it relates to capital gains and basis. So, let's explain that.
Okay.
So, let's assume I buy an investment. I put $100,000 in it.
Okay.
10 years later, it's worth $250,000.
Okay.
I had a good 10-year run. I more than doubled my money. If I wanted to sell that $250,000 investment, you would take the $250,000 minus the $100,000 of cost basis. That's what I paid, and that would leave me with $150,000 capital gain.
Right.
Okay. What President Trump is proposing by indexing inflation would be that your basis wouldn't be $100,000. It would be $100,000 plus inflation for each of those 10 years.
Right.
Right. So if inflation's 3% at $100,000, I'm not smart enough to do that math in my head right now, but maybe your $100,000 basis goes to $150,000.
Right.
Right. So now you sell at $250,000. The first $150,000 is tax free. You're only paying tax on $100,000 of capital gains. So that's pretty significant.
Oh yeah.
Right. That's probably more significant than cutting the actual capital gains tax rate.
Right.
Right. And typically when the tax rates are cut, stocks go higher. After tax returns are higher. You've got an unlocking effect where investors typically have locked in long-term holdings when capital gains tax rates are high. All of a sudden they start to blow out us. Like, look, man, I've got some clients who have legacy positions like AT&T,
Oh yeah.
GE, just old positions that maybe they inherited, low cost basis, but they're dogs. Like they're not keeping up with the market.
Right.
ExxonMobil, so like just these big, huge, quote unquote blue chip companies that they have been unwilling to unwind.
Right.
You give them an opportunity to unwind, they will. and then they will move into the higher growth stocks.
Right.
And as we know, the 5 biggest stocks in the S&P make up 25% of the index. As go the big boys, goes the rest of the market.
Right.
Right? So I think that, from my perspective, that is the one policy change that could be a catalyst for the S&P 500. They could take us from 3,400 to 4,000. They could.
And it's my understanding as well that Trump would be allowed to do that via executive order.
Yes.
So,
Which is basically what he did for the unemployment
Right.
and stuff like that, right? Congress couldn't figure it out. They never can.
yeah, and
They were literally trillions with an S. That was trillions with an S at the end, plural, right? Trillions of dollars apart. So Trump stepped up and said, hey, these are the 4 most important things that we need to keep going. And he signed the executive order, and boom, they're done.
yeah,
Right?
it's just, I mean, we talked about it a couple weeks ago. Just the legislative body of our government is just completely useless.
It is.
Just completely useless.
It is.
They can't get together and extend just the stimulus for the American people that they're supposed to be serving.
Yep.
You know, that's not a political statement. Just as a body, they're completely useless.
Exactly. Yep.
So yeah, you know, it's I don't know. There's some legality issues on that side for how long it can go, but this specific one on tax cut proposal on the indexing of
Yeah.
the capital gains rate, I think is a fantastic idea. First of all, and
It seems fair and reasonable.
it does,
Right?
sit there, and we have to do a 10-year, you know, unwinding plan to sell
Yeah.
those stocks off, so we don't generate huge tax bills.
When you get out of dogs like that and into the winners, that's good for the market.
Oh yeah, for
Yeah.
sure. It's good for everybody, really.
Yeah.
And it's good for the government as well. If there's higher gains to pay, even though you're indexing,
Exactly.
they're going to get more money in the house.
Yep. That's the idea.
So it is a great idea. You know, I got a client who has a bunch of Apple stock, a significant position at basically like $3 cost basis.
Oh my God.
So,
I'm jealous.
Me too. And I've been an Apple fanboy from way back.
Yeah.
But yeah, something like that, because he's had it for so long. You know, almost as long as probably Forrest Gump.
Yeah.
But if you index it, you know, it'll definitely make a big impact on the tax bill and
Yeah.
allow him to diversify his portfolio.
Yeah.
And oh, by the way, he's still paying taxes that he otherwise wouldn't have, right? He'd just be holding it.
Correct. Yeah. He would continue to defer that capital gains
Right.
tax. Instead, he's actually
they're-
going to pay it.
Exactly. So
Okay.
they're-
Hey, I can get a reduced tax rate. Here's another, $100 billion for the U.S. government because we all decided to unwind the dogs in our portfolio that have low cost basis.
and the stock market goes up.
Yeah. So it could be a very, very good positive catalyst for the market. That's the biggest one I see. Are there any out there that you think are bigger than that, or any that our listeners should be aware of that could take the market higher given the fact that we're at all-time highs again and we haven't even fully recovered from COVID-19?
No, you know, I think that's the biggest one right now, and we've seen it, right? We've seen it since 2016, where policy change, unwinding some of the regulations, reducing the corporate tax rate. All these things are going to spur the economy along, and keep the market pushed up as well.
Yeah, no doubt.
So it's definitely one to keep an eye on.
Yep. All right, so that kind of wraps up today's show. As always, thanks for joining us on today's episode of The Capitalist Investor. As always, shoot us emails at info@swpconnect.com. Go check out the show notes, check out our YouTube channel, and we look forward to talking with you next time.